macro market trends, stock selection, ETFs, options. Just some of the topics covered in Cook's Kitchen.
What if you had only one technical indicator to warn you of a coming correction? I'm going to show you one I think you should be aware of. I met a gentleman trader about 5 years ago when I was at Peak 6, his name is Chris Rowe, and he was an ETF timer and did a lot of technical work. You may have heard his name before. He follows the Bullish Per Set Index on the New York Stock Exchange in a special way as an indicator of a correction, and it's worked for him many times, and I'm going to show you those in a minute. Let's review what the Bullish Per Set indicator is. All right, Bullish Per Set Index. It can be used as an indicator, but let's just describe the index. It's a breadth indicator based on the number of stocks on a point and figure buy signal within an index. Now, if you know anything about point and figure charting, a stock is either on a buy signal or a sell signal. Point and figure is very clear, buy or sell, and so you add up the number of buys in a given index and then just describe that percentage. BPI is a straightforward indicator with clearly defined signals. I think you can see that from what we're talking about here. Now, the way that Chris uses is he looks for a peak in the Bullish Per Set Index that is later followed by a peak in the index itself. So he looks at this as a very leading indicator. And we have a lot of different measures of market internals and breadth. I look a lot at advanced decline statistics using the McClellan oscillator and the McClellan summation index. But this one indicator is Chris's favorite for predicting a market correction. All right, so I'm going to show you a 3-year chart here. Now, I chose this color scheme because it was the best combination I could find on stockcharts.com to highlight what I'm doing here. The green is the Bullish Per Set Index on the New York Stock Exchange. So BPNYA is the symbol there. And then plotted behind that is the price of the S&P index for the past 3 years. So if it's hard to see, here's the uptrend of 2010 into 2011 in the S&P. Then we topped, big correction, summer of 2011. Then 2012 had a nice early rally, correction. Then we come into, here's our big rally now to all-time highs this year, 2013. All right, we're going to zoom in now because I want to show you what's going on here and what's happened before. All right, the way Chris uses this, again, I remember I said that the Bullish Per Set Index makes a new peak, which is what we have up here in late May, above, looks like over 80% on the Bullish Per Set Index. But the market still hasn't peaked. Then down here, Bullish Per Set Index comes and makes a new low. So I'm not drawing trend lines as much as I'm just trying to connect the idea we made a lower low in the Bullish Per Set Index between April and into the June correction. And it was in late June during this correction that Chris said, okay, this is what I'm looking for now. I'm looking for a rally back to new highs on the index, because this is how this indicator works. It leads. So he's saying, okay, here's what the Bullish Per Set Index has done. Now I expect the index itself, the NYSE index, stocks in general, to make new highs. So let's go back to the chart. That's exactly what has happened. After the June correction of, 6%, we make new highs on the index, but the Bullish Per Set Index made a lower high, and I've just connected those. And this is his indicator now where he started getting short into July because he believes that a bigger correction is now coming. I'm not sure what else I can say about this. I've given you, I think, enough of the details. I probably left something out, and I'll put it in the comment section underneath this video. Feel free to leave your comments, and let's discuss this, because here we have a single technical indicator. We're not talking about the economy. We're just looking at the internals of the market, and it's worked for Chris Rowe. We're talking going back. This worked in 1998 for him. Then it worked again in the 2007 top, the 2010 top, and the 2011 top, and I think it maybe even worked in the 2012 top. So he almost has a near perfect record using this indicator, as I described to you, for calling a correction. Remember, the idea is bullish percent index makes a new bull market high, and then a month or two later, the index itself makes a new high as the bullish percent index starts to roll over. That's what we're looking at right now. One indicator, not saying that a correction is coming, but I'm showing you where it's been used successfully, and one gentleman who relies on it in combination with other things. This is one of his biggies. So, we've got this market stalling here now below 1,700, and a lot of profits on the table. So I'm a bull who's looking at the exits too, as I'm sure a lot of others are. All right, thanks for joining me in the kitchen, and we'll see you next week. We'll take a look at a few more charts.